Welcome to the Retirement Architect with David Reyes. Our program is designed to not only provide insight, but to educate and give you the tools you need to design and build a rock-solid retirement.
Back with the Retirement Architect, David Reyes of Reyes Financial Architecture. David, we are closing in on the last couple months of 2022. It has been an interesting year, to say the least, and a turbulent year in the markets. But in order to make as much financial progress as possible, we've got these last couple months to maybe make some proactive financial strategy moves. Are there any things that you suggest for your clients or proactive savers and investors to end this year and begin next year in the best shape possible?
Yeah, I think this year's a unique year in the sense that we have a lot of competing issues with inflation in the stock market, all the turmoil. But from a real pragmatic standpoint, it's a great time just to reevaluate everything. Whether it's your budgets, whether it's your investment plan, your retirement plan. If you have an advisor, I'd recommend you sit down with them and make sure that you're on track. Talk to them about your portfolio. What are the things that you can do to help mitigate the risk or maybe, put it in a better position for next year. So there's a myriad of things to do. We focus, first off, we do a lot of second opinions for clients that have advisors, right? So I would always recommend that as well. If you're unhappy with your advisor, always give that advisor a chance. I'd rather have somebody, and I tell clients all the time, hey, if your advisor, if there's some tweaks, talk to your advisor about it. And I tell clients that all the time, move your money, unless we can make a massive impact, which we can most of the time. But if it's just a tweak here, tweak there, I say keep your advisor. But the fact is review your plan with your advisor and make sure that there's things that can be kind of the trimming, pruning type of stuff. Unfortunately, this year, it's been a lot more than that. I mean, there's a lot of pain out there. In fact, I have to say, this is probably, unfortunately, the most nervous, and I can use the word scared, I've seen clients since 2008. It just has not, and they're getting the paralysis by analysis, kind of proverbial deer in the headlights. And that's just not good because no decision is a decision. And I'm seeing some clients, some prospective clients, very hesitant to make moves or decisions because they're so scared. And I tell people this all the time. And it's a big piece of advice I'll give right now. If you have that mindset, you have the wrong portfolio and you have the wrong advisor, period, end of story. If you're frozen, whether you're your own advisor, you need to fire yourself and find somebody else. If you have an advisor and you feel that way, you need to find a new advisor because you shouldn't be in that pain point psychologically because it causes us to make bad decisions, right? And typically those bad decisions are like a domino effect. Well, we had a portfolio A here today, and then we change it because we're scared. And then now we go to portfolio B or plan B, and then we're chasing our tail. And so if I had to give one piece of advice right now, it's talk to your advisor. If you're your own advisor, have a talk with yourself and your wife. And if you're unhappy or concerned, get a second opinion from somebody who you can trust to do that. And that's the biggest piece of advice I can give because I feel bad for clients right now, for retirees, because they're scared.
One specific topic that seems to cause us a lot of pain is taxes, but There are some proactive, strategic year-end tax moves that we could consider. One of them being tax loss harvesting. Yeah. Can you talk to us about why this may be a consideration before the end of the year?
Yeah, for sure. Especially the only time tax loss harvesting, I would say the only time, when we've used tax loss harvesting for 20 years, a long time, right? What does that mean in English? Basically, we're taking winners and losers. I own Apple and I own, Netflix or whatever, right? Apple's up, Netflix is down. I can sell shares of Netflix and sell shares of Apple and not have a taxable event, right? So trim some winners, sell some losers, but not create a capital gains tax. There's some rules involved with that we won't get into right now. But right now is a really good time to do that because we have losses. Right. I'll give you a good example. I got a client right now, she just went through a divorce, right? Her husband was a very aggressive investor. It's made him a lot of money. This year, they're getting hammered. So their biggest position was Tesla. It is Tesla. But he owned all the ARK funds, right? All the Cathie Wood funds. Now, I love Cathie Wood, but her funds are down 70% this year, right? So you can imagine, right? The Tesla stock that she's owned now for about 6-7 years. They've made a lot of money, thank God, on that. But all their other positions lost money. So here's the nice part. We have been doing this throughout this year, this last quarter, this last half of the year, selling those ARC funds we sold a while back, and then we're starting to sell some Tesla stock to offset, to be able to capture to sell some Tesla stock to diversify and not pay tax on the Tesla stock. So that's a really good example. If you have these really bad losers, well, let's offset some of that pain by reallocating and saying, okay, I'm going to sell some of my winners too, because most of our portfolio is Tesla, right? Which thank God it was, because it offset all the bad losers. So that's a good example of how I can turn kind of a negative into a positive. Sell stock I like to redeploy capital to maybe diversify my portfolio more and take advantage of losers. So tax loss harvesting is a big one that we use quite often.
May feel a little bit like pouring salt in an open wound at some level, but Roth conversions actually a good idea when we see markets decline.
Right. Yeah, Roth conversion, we're really big on that right now. In fact, I had a client retire 2 years ago, and he was in law enforcement, and his salary now, he got hurt on the job. So guess what? His salary is all tax-free. So what we did this last 2 years, we've all just took his salary, which was $200,000 a year. We just did basically, in his mind, free Roth conversions, because he just paid income tax on his salary as if he was still working. He's retiring officially this year off disability, but we put $400,000 in, we paid taxes on it, but we didn't pay any tax on his income. So basically transfer all that money over. But you're right. It's best to do Roth conversions if you can pick a time when markets are down. Because basically what I can do is reposition those assets, pay the tax today, offset the legislative risk that we have. Who knows? We got a midterm elections coming up. Who knows what crazy stuff's going to go on? We know Biden already wants to raise taxes significantly. He's talking about a capital gains tax for certain demographics being, ordinary income taxes, right? He's already raising the marginal tax rates at the highest brackets as well. The problem is when the government can control your taxes, they can do whatever they want. And we're still at relatively low tax rates. Even if we just went back to 1980 tax rates, our taxes would almost double. So it's a great move anyway to prevent legislative risk, tax risk. But it's a great time to do it, because at least we can take advantage of the pain we've had in our portfolio and reposition those assets. So when the market does come back, we have these tax-free assets now.
Now, not a strategic move. In fact, not even an option. Required minimum distributions are something that we have to take care of before the end of the year.
Yeah, so RMDs, if you're 72, which is the new age, it's around 3.5%, is somewhere 3 or 4% as a distribution rate. Roth conversions help with that, of course, because we're reducing the amount we have to take out. We can do some qualified charitable deductions where we can send up to $100,000 to our favorite charity directly and reduce taxes on that.
One of the only opportunities for truly tax-free money.
That's right. That's right. So, the only tax-free money with life insurance policies, borrowing money on tax-free basis, municipal bonds, and then, of course, Roth conversions, which are my favorite because we can own any asset we want inside of the stocks or bonds inside of the Roth. So, yeah, we're very aggressive with Roth conversions. When you have the kind of debts we have right now in our country, one of the only ways out is higher taxation. You're already seeing it happen. Typically, you don't talk about in a recession, which we're basically in. You don't raise taxes in a recession. So, you don't want to ask me about that one. You already know how I feel about that. But the fact is that that's the kind of administration that we have right now. That's the kind of issues that we're dealing with. And that concerns me, depending upon who's in the White House and Congress and Senate, what's going to happen on a forward base. So I think it's just smart business to have a plan to consistently move assets into tax-free vehicles.
Finally, under the heading of the proactive year-end tax maneuvers, take a look at your different accounts where you have the ability to make contributions and take full utilization of the tax advantages that are available. Now, on an ongoing basis, but particularly in times where the market is more volatile, rebalancing is a big opportunity and something that we should look at before year-end.
Yeah, in our world, it's pretty rudimentary, right? A lot of advisors, we're rebalancing. I mean, that's not rocket science, right? Everybody does that. So I don't want to overstate it. But the reason that I'm glad you brought that up is because in markets like this, rebalancing is very powerful because it's kind of counterintuitive, right? David, you're telling me to allocate more to stocks right now in my balanced portfolio? Yes, right? Because we're basically, buying low. Right. And so the fact is that during times of volatility, rebalancing is more impactful. We don't even look at rebalancing portfolios in bull markets for like 1 or 2 years typically. right? Because the counter to that in a bull market, you rebalance, you're cutting your stock exposure and you're actually making less money. But when markets are like, especially when you had significant losses, 20% plus, you definitely want to look at rebalancing the portfolio.
And as part of that rebalancing consideration, also maybe looking at and evaluating alternative options. A lot of people aren't really thrilled with the performance they've seen in their portfolio this year.
Oh, for sure. I mean, as we've talked about before, we use real estate, we use annuities in certain instances for clients. The great part about annuities, and this is not an annuity, commercial here, but, and I've used annuities as an asset class for 27 years, since 1995. I will tell you, the last half a dozen years, I've used them in a very smaller way than I have in the past, because interest rates have been so low, and insurance companies make they make their money from interest rates, right? So the fact is that this last year, you've seen the products get really, really competitive now, to where they're a great alternative. Where I don't care how much money a client has at this point in time, clients need to look at an annuity that has some principal protection behind it, fixed index annuities, income annuities that we can use as a way to mitigate risk, but still have some upside potential. And so real estate's one we use, good fixed index annuities, low cost index annuities that have good upside. We were talking off camera about this as well. There's some now that can pay up to 10% plus, on the upside on a year over year basis. I mean, that you can't ignore that. It's something that I don't care if you hate annuities. We use them as a part of our tool chest. I always tell clients I'm colorblind when it comes to investments. I could care less if it's a stock, bond, mutual fund, annuity, real estate. What does it do for my client? What's the risk? What's the reward? What's the cash flow? And that's kept me out of trouble too, because again, we talked about earlier that bonds have not been a big part of our clients' portfolios for many, many years, and now they're actually a part of that portfolio. We can now start, instilling into what we're already doing for our existing clients.
And into a related topic, generating durable, dependable, consistent income, especially in volatile markets, can be difficult, nerve-wracking, quite frankly, scary. So reviewing your income plan on an ongoing basis is always a recommendation.
Yeah, unfortunately, most advisors and retirees are doing some type of generic, put your $1 million in, and this magic formula comes out that you're going to be fine. Well, problem is that most of that stuff's all hypothetical, back tested on what the market's done for the last 100 years. We're much more judicious about that. We're much more pragmatic. We want actual cash flow. We don't want to be having to sell our stocks and our investments and hope and pray we don't run out of money. And unfortunately, the average baby boomer, average retiree, that's exactly what their advisor is recommending that they do, which is dangerous. So how do you avoid that? We'll do a whole show on this because it's worth it. You want to look at investments like, if you need some income, let's create our own pension through a guaranteed lifetime income annuity, guaranteed by the principal, by the claims paying ability of the insurance company. We can even look at U.S. Treasury bonds now as a piece of that, which I can't believe I'm saying those words together. We can look at investments, such as real estate, good conservative real estate. We happen to use pharmacy, grocery discounters like CVS, Kroger's, Walgreens. I've used that for over a decade. Pretty low on the risk scale, not guaranteed like an annuity or a treasury bond, but a way to create cash flow that I can still keep my asset. We like dividend paying stocks. Another way, live off the dividends, not sell the stock. All those things I think you need to do. Giving this talk last week I just gave, it's not easy. If you want to do retirement planning the proper way, it's hard. It's complicated. Taxes, Social Security, pensions, the bond market, stock, what do you do? Most people are going to be okay that have maybe a couple $1 million. They'll probably can make a lot of mistakes and be okay, but not everybody's in that position. And I think we have to be much more precise about our planning now in this time, in this day and age.
And then a few fundamental reminders, I think, for year-end to-do items. Run a credit check, review your budget, control your spending. Don't overspend during the holidays. And if you have it, address any debt, because that debt's going to get more costlly with these rising interest rates.
Exactly. So there's all those things that we want to do. I think the budget's a big one right now because, I mentioned earlier that, we have a client, one of my first clients almost ever, that's called me up and says, David, I need an extra $500 a month. And that's really never happened. Because when we do our planning, we're planning for everything, the trips, the inflation, the kids. And so that was concerning to me that because the retirees, because they're not buying new cars and new houses all the time. So
that inflation has had that kind of impact.
Oh, absolutely. Absolutely. And, we're blessed. Our clients have money, they save their pennies. We're just now stewards of that money with them. But for the average person that saved maybe $100,000-$200,000, the average American, and they have Social Security and they have their investments, they're having real problems right now. And so, we do everything we can to help as many people as we can because it's very challenging right now.
Well, there are many items that you should consider as we close in on the end of the year. This is just a checklist of a few of those items. But if you want to get into the detail and figure out if there are any risks, issues, opportunities, or proactive moves that you can consider before the end of the year, give Reyes Financial Architecture a call. The retirement architect, David Reyes, will sit down with you for that complimentary review and retirement planning strategy session. 858-597-1966. That's 858-597-1966. Or you can visit reyesplan.com. That's REYES plan.com. Reyesplan.com. David, always a pleasure getting your time and perspective here on the program.
Thanks a lot. Talk to you soon.
Thank you for spending your time with us again this week. Get the most out of your retirement plan. Call 866-REYES-PLAN. That's 866-REYES-PLAN. 866-739-3775. Or visit reyesplan.com.
No information presented today should be acted upon without meeting with a qualified and licensed professional. Reyes Financial Architecture, Inc., RFA, is an SEC-registered investment advisory firm. Such registration does not imply a certain level of skill or training. For a copy of RFA's current Form ADV 2A brochure that includes a description of services provided, fees charged, and other important information, call 858-597-1966 or go to advisorinfo.sec.gov. RFA also is a licensed insurance agency with the state of California. License number 0G66604. This show is provided for informational purposes only. Opinions expressed in the show reflect RFA views as of the date of the recording and are subject to change. Nothing should be construed as a comprehensive statement of the matters discussed, considered investment, financial, legal, or tax advice, or a recommendation to buy or sell any type of security, and no investment decision should be made based solely on any information provided. Any forward-looking statements or forecasts discussed are based on assumptions, and actual results can vary from any such statements. Some of the information provided has been obtained by third parties and believed to be reliable, but not guaranteed. Past performance is not an indication of future returns. With respect to any discussion about RFA investment strategies, there's no guarantee that they will be profitable or perform as described during the show. RFA or one or more of its employees may have a position in the securities discussed and may purchase or sell such securities from time to time. All investments in securities carry risk, including the risk of losing principal amount invested. Different types of investments involve varying degrees of risk. There can be no assurance that any specific investment or investment product will be profitable or suitable for a particular investor's financial situation or risk tolerance. Asset allocation and portfolio diversification cannot ensure or guarantee better performance and cannot eliminate the risk of investment losses. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing insurance company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Surrender charges apply to base contracts. Optional life income benefit riders are used to calculate lifetime income payments only and are not available for cash surrender or in a death benefit. Fees may apply. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. Rates and returns mentioned on this program are subject to change without notice.